All right, y'all. Welcome back. Thank you all for joining in. If you didn't see today, if you're not part of the market, or if you're just getting home today, um, just what's on the screen right now. I don't have the ticker just quite yet, but let me just zoom out a tiny bit. Netflix. So Netflix is down 25% after the market. 25%. And I mean, even on a year-to-date chart, it's down, give or take, what is that? I don't know, from almost $600 it's down to $258. So it's about 50-60%. Just about. So if you guys are wondering what happened today, we're going to go through it today. Make sure you guys stay tuned. If you guys like any videos like this, let me know down in the comments below. As earnings season comes up, I'm hoping I get to make a little bit more of these. I had no plans for a video today. I like to do a little bit more of the ones with the actual camera. But again, this happened a little bit faster than I thought it was going to go to. So first things first, they had their earnings today. Their earnings were meh at best. They weren't amazing. They weren't, I don't think they were as terrible as people thought they were, but they weren't the best. So let's hop right into the earnings release that they had. So I'm not going to go over every little thing. If you want to, just go on their investor relationships website, the shareholder letter that they put out. I'm just going to go over some of the key things that I really noticed and some of the things I wanted to touch on. So the first thing that they said was our revenue growth has slowed considerably as the results and forecasts below show. Streaming is winning over linear as we predicted, and Netflix titles are very popular globally. Not surprising there. However, our relatively high household penetration, when including a large number of household sharing accounts, combined with competition, is creating growth headwinds. That's interesting. Household penetration. So they're talking about, you have one person that owns the account and then it gets shared. It's not even just households, like an actual, like people that live within a house. It's across different states, possibly across different addresses, just within the same city. A lot of people share accounts. This is something that Netflix has touched on, and a lot of consumers aren't too happy about. But I mean, Netflix is going to do what Netflix is going to do to benefit the company. So you can see for the quarter, their revenue was 7.868 billion, and then obviously the year-over-year growth is just shy of 10%. Operating income of almost 2 billion. You got an operating margin of 25%. You got a net income of 1.5 billion, and then you got diluted EPS of $3.53. And I believe this was slightly above what the estimated was. I think the estimated was like somewhere around like 250, 260 EPS. So that's pretty good there. But this is really where a lot of people were concerned. So the global streaming paid memberships is at 221.64. And what happened was that year-over-year growth is 6%. But they had a paid net additions. It's actually a loss. So they lost people. And they plan to lose more people as they guide forward. And I just want to compare this really quickly to what they had originally said. So let me just show you what that looked like before. So on the left, you have the Q1 2022 actual numbers. And then on the right, this is from their Q4 letter, Q1 forecast. So they estimated 7.9, they hit 7.86. They had a 10% year-over-year growth. That's a 9.8%, obviously. And then on their net income was a little bit higher than what they had originally forecasted. But here's what happened. They estimated they're going to get 2.5 net additions, and they got negative 0.2. And this is talking millions. This would be 200,000, 300,000 people. But really the big component in all of this is that I think that what we're starting to see is Netflix is realizing, okay, we're hitting all the households, but letting people have multiple accounts or multiple profiles underneath an account is becoming an issue. And they did do some testing with the passwords and making sure that people had to like confirm you had to confirm a code to your computer, code to your phone or something like that to make sure that it was actually you watching it. They did test it out with some people, but what they believe is that their key to success is our ability to create amazing entertainment from around the world, present it in highly personalized ways, and win more viewing than our competitors. That's really how their plan as far as like what they're trying to do and go out and do. So that's really like the big component of why it's down so much is just the amount of people that didn't sign up and the amount of people they plan to still lose. And I'm going to touch on here in a second why what really led to that, but let's look at their growth outlook real quick. So first, these are kind of the 4 things that they can see. So now we believe that our 4 main interrelated factors at work. First, it's increasingly clear that the pace of growth in our underlying addressable market is partly dependent on factors we do not directly control, like the uptake of connected TVs, the adoption of on-demand entertainment, and data costs. We believe that these factors will keep improving over time so that all broadband households will be potential Netflix customers. Second, in addition to our 222 million paying households, we estimate that Netflix is being shared with over 100 million additional households, including over 30 million in UCAN, that's the United States and Canada. Account sharing as a percentage of our paying membership hasn't changed much over the years, but coupled with the first factor means that it's harder for us to grow memberships in many markets, an issue that was obscured by the COVID growth. So they're talking, when they say COVID growth, they're talking about a lot of COVID pulled forward a lot of the demand that they would have seen, over the next couple of years. A lot of it got pulled into 2020 because people were all at home. But one thing they did mention was third, competition for viewing with linear TV as well as YouTube, Amazon, and Hulu have been robust for the last 15 years. However, the last 3 years, as traditional entertainment companies realize streaming is the future, many new streaming services have launched. While our U.S. television viewing share, for example, has been steady to up according to Nielsen, we want to grow that share faster. Higher view share is an indicator of higher satisfaction, which supports higher retention and higher revenue. So, I mean, you can see it here. They've kept that market share over time, and it's up a tiny, tiny bit. And I'm going to show you guys a churn rate here after we go through the letter. But the fourth factor is the macro factors. So including sluggish economic growth, increasing inflation, geopolitical events such as Russia's invasion of Ukraine, and some continued disruptions from COVID are likely to have an impact as well. So I just want to touch on this real quick. So the sluggish economic growth, I think one of the losses or things that happens with Netflix is you pay monthly, and you can cancel it at whatever time. I mean, that's a benefit for the consumer, but it's not a benefit for the company. Versus if you buy a cable package, you have to sign up for a year, sign up for 2 years, whatever it may be. So people can't just, cut cable. I mean, they can, but they're not getting that money back, and it's probably going to be put as debt on their items. Increasing inflation, again, if push comes to shove, food's going to come before Netflix. Netflix is a want, not a need. Even though it has replaced a lot of things, it's a want, not a need. Third, one thing is that Russia's invasion of Ukraine, it really proves that if geopolitical events keep happening like this, like if another country gets raided, they actually lost viewers from Russia, obviously. So that is one thing that I also wanted to point out, which I think is very concerning. Now, back to what I was talking about earlier with the whole sharing and the account sharing. Another focus is how to best monetize sharing the 100+ households using another household's account. They think that this is a big opportunity. Again, they've touched on this multiple times, that this is an issue as far as revenue growth goes and getting paying customers. I do think that personally, if they start banning shared accounts, or they make it really hard for you to share an account, people will probably drop off of Netflix for a little bit, but it'll likely come back in over time as people just kind of go like, all right, I want to watch whatever show I want to watch. Or what'll end up happening is people will pick one of the streaming services or two, especially because right now Netflix is, is almost double or triple. No, it's almost double Disney Plus. Disney Plus is $7.99 and Netflix is $15-16, and it's going up. So as far as what they can do, they need to really penetrate more households, or really just have more people signing up for these accounts for them to make more sales, especially if they're going to be charging people, $15-16 or even more, depending on what you're trying to do. So again, the sharing likely helped fuel our growth by getting more people using and enjoying Netflix, and we've always tried to make sure within a member's household, make sharing within a household easy with features like profiles and multiple streams. While these have been popular, they've created confusion about when and how Netflix can be shared with other households. So early last year, we started testing different approaches to monetizing and sharing, and in March, introduced 2 new paid sharing features, where current members have a choice to pay for additional households in 3 markets in Latin America. There's a broad range of engagement when it comes to sharing households, from high to occasional viewing. So while we won't be able to monetize all of it right now, we believe it's a large short to mid-term opportunity as we work to monetize sharing, growth in ARM, revenue, and viewing. And we will become more important indicators of our success of membership growth. So that, again, it's one of those things where they're going to do it, It's just when. And I think that if you're looking at this company and you're seeing this drop and you like the valuation, you like the prospects, I do think that Netflix as a company has become more and more sticky in people's lives. Not that people won't ever get rid of it or aren't willing to get rid of it, but I think that as far as, people dropping it, I think Netflix is only going to get better on their paid content and what they pay for rather than licensing other people's content. I think that that's a very, very big opportunity that could probably present itself given that, you believe the story. So the last thing I want to touch on, at least for right here, is this paid net additions. So again, their paid net additions, they 0.2 million, so they lost 200,000 people, compared against our guidance forecast of 2.5 to 4 million people added in the same quarter. Suspension of our service in Russia winding down of all Russian paid memberships resulted in 0.7 million impact. So 700,000 people were impacted on that paid net ads. So realistically, their paid net ads was really more so 500,000, not necessarily the negative 200,000 that we saw. But again, this does speak to the fact that, their forecasting was way off, but who could have predicted the whole Russia-Ukraine situation? So it is something to note, but you'll see here in a second what it looks like by each region. And then again, they had a pretty good, cash generative quarter. They had some good free cash flows up, obviously. And then they kind of expect the same thing going forward for this year. And again, they're forecasting that. So what happens in reality depends on, just different situations that are happening in the macro market. So looking at the regional breakdown of their letter, the revenue, you can see what their revenue is for Q1 2022 versus the last 4 quarters, or I guess technically the previous 4 quarters. Again, if you look at the net additions, you had a bunch of regions that were losing people. So you had UCAN lost 640,000 people, EMEA lost 300,000 people, LATAM lost 350,000 people, APAC added 1 million. So as far as, paid memberships go, it's possible that APAC ends up being one of the pushes that they need. But we're gonna have to see. They're doing a great job though of trying to introduce international films, because normally we export films to other countries, but they're trying to create more content that's relatable to those people that live in those countries. So Squid Game was a really big one where, it was a Korean film, but a lot of people here in America really, really liked it, and it was a huge hit across the globe, really. And I think that if they can get more hits like that, where it's not just a regional show, it could be, across many different regions, I think that could be very beneficial for a lot of people going forward. So the last thing I want to touch on is their statements. So obviously you can see the revenues versus the last couple of quarters. And then obviously you have their EPS. So you have Q4 2021, and then the year over year would be March 31st, 2021. Again, you have their balance sheet. So their balance sheet's going up steadily, and that's always great. One of the things I liked was that they got rid of their short-term debt. That's always really good to see that. And then obviously the long-term debt is ticked down just a smidge. But you do want to see their debts go down. You don't want them to be too over leveraged, especially because they're building a lot of shows right now. So they need the debt to fuel these shows and licensing and stuff, but you want to make sure that if they're taking on debt, that it's going towards things that actually return value to the shareholders and value to the company overall. And then one of the things that I liked was you obviously have your statement of cash flows, but at the bottom here, they laid out their free cash flow. So they did it by each quarter, as I mentioned earlier. So you got your current quarter, March 31st, 2022, Q4 2021, and then you got March 31st, 2021. So obviously, around, what is this, $800 million worth of free cash flow for the quarter. That's pretty good. They can keep that up. You have $2 or so billion in free cash flow by the end of the year. But again, they're going to make huge investments into different infrastructure and things. So I would definitely watch the statement of cash flow and just sort of the free cash flow and see where it all goes, or at least understand, if they're going to go negative like this, you need to understand what that money's getting put into. Because again, they have to create a lot of shows, they have to license a lot of shows. So this money's kind of going all over the place. So as far as this company goes, what is the valuation? So the market cap's 151 billion. Obviously, if you take that out, the market cap's going to come down 25%. So let's just take that times it by 0.75. So it'll be about 113 tomorrow. My guess is that by the end of the week, it'll probably be sub 100, which that would honestly be crazy if they hit below 100 on the market cap. I think I was reading earlier that this hadn't hit this price since 2018 at some point. Which is kind of crazy to think about. Their PE is obviously going to drop along with that, probably be around 20. And as they, kind of move forward, we're going to see what it really is. Their PEG ratio is obviously going to drop. I mean, everything in here is going to drop because the price dropped 25%, as you can see up here. So not super surprising. Their ratios aren't terrible. That's what I'm saying. I think this might be an opportunity for some people if you understand sort of the macro environment that they're competing in now, because a lot of companies are truly getting into the streaming. So it'll end up, my guess, it'll end up becoming like the whole cable service ended up doing. It grew really, really big and then it tapered off because, there's only so much money that people are willing to put around. Again, all this stuff doesn't really take into the current numbers today. But one of the things I did want to note, where is it? Up here. So their 52-week high was $700. Oh my God. 52-week high was $700, and they're gonna hit 258 opening tomorrow. That's pretty crazy. So down 65% since the 52-week high. That's not good. So I just wanted to touch on this really quick too. We were talking about this in a Discord that I'm in. The active churn rate. So the active churn rate for, Netflix and Disney Plus are the two lowest on this chart. Netflix is at 2.4%. So really what the churn rate is talking about, it's referring to, the amount of people that are sort of getting, like how much they're getting rid of. And just how much customers are really going through. So with Netflix at the lowest, and surprisingly Apple TV is at the highest, 6% seems to be the average between all of them. And I'm curious to see over time if Netflix keeps ticking up or if Netflix stays where it is, or how that competes. Because I think that the churn rate is definitely a big component of how you see this company doing well going forward. So this is something I would definitely pay attention to. I got this from streamable.com. They actually released this on January. So this doesn't even take into account the last couple of months. But it's something I wanted to touch on because I think that's very important that you see the churn rate and it's just something you follow. If you're getting into streamers or any sort of company like this, make sure you're watching this because this is something really big that you should be paying attention to. As you know, I'm in Discovery, or technically Warner Brothers Discovery, obviously they merged, so HBO Max and Discovery Plus is something I follow. But if you're into Disney, Disney Plus, and Hulu are definitely something you want to follow as well. Anyways, y'all, I hope y'all find some, good answers here and see if read that 10K or 10Q and make sure to go through the earnings and all that things, see if this is an opportunity for you. I'm going to be going through this probably in the next couple of weeks just to see if there's anything there. Bill Ackman is currently in this now too, so I wouldn't be surprised to see him keep buying, especially as this dips 25% tomorrow and then it's probably going to go down for the rest of the week. So I wouldn't be surprised. But I hope y'all had a great day. Good luck on your earnings. Make sure you guys are reading those letters and listening to those calls. Let me know if you guys have any comments down below or if you have any suggestions. Anyways, y'all take care. Have a great day.